Hi, everybody, and welcome to Signature West Podcast. I'm your host, Sam West from Palm Springs, California. As you all know, I'm a seasoned real estate agent since 1991, and I bring you the podcast to bring you inspiring stories. If you want to find out more, go to www.samwest.co. Most of us have heard of the possibility introducing the option of a 50-year mortgage in addition to what we have now, which is 30 years or 15 years. And I read so much comments online about how bad this is and how terrible the idea is and how not okay. So I wanted to bring the professional in the mortgage world to dissect it and to break it down, the pros and the cons, and just figure it all out and let you all decide what you want to do. Say hi to Camille Mirabet from Contempo Lending here in Palm Springs, California. Hi, Camille.
Hi, Sam.
How are you?
I'm great. Thank you for having me.
Good morning. Good morning. It's Friday. It's raining here.
It's a beautiful rainy day.
So I'm sure you've been getting calls or maybe, heard or past clients or future clients are kind of like, just freaked out, for lack of a better word, about the new possibility that just get introduced, I don't know, like a week or so ago. So let's just start with what we all know as the normal, which is the 30-year option when somebody applies for a mortgage, or a 15-year option. And correct me if I'm wrong, 9.9 out of 10 people get the 30 years because the 30 year, because the 15 years is like almost double. You pay it off sooner, but it's like kind of at least double or maybe almost double.
Yeah, I think that's fair to say.
Yeah, it's like, okay. So I don't know how many people that you know of that got a 15-year mortgage since you've been doing this.
Quite a handful. Like you said, definitely not as much as a 30-year. A lot of it has to do with affordability. It's easier to qualify for the 30-year because the payment is lower. But if they can swing it, for lack of better terms, the 15-year, you do pay less interest over the life of the loan. Typically, you get slightly lower interest rates, but you do see those every now and then.
Who's the buyer? Who's the buyer that would apply for your typical buyer that would apply for a 15-year mortgage?
Typically somebody with strong income who can afford the housing payments. When lenders qualify buyers, they're qualifying them on the gross income. Now, obviously, that's not their take-home pay. So a lot of them have pretty strong incomes, the ones that are doing 15 and even 10-year terms.
There's a 10-year?
There are 10 years, there's 12 years, there's 13 years. You can customize it any way you want.
Are you serious?
Yeah, absolutely.
Well, as long as I've been doing this, I've never heard of it. But okay. I can't even imagine a $300,000 mortgage over 10 years, how much that will be. That's a whole different conversation.
Yeah.
But because for the ones that don't know, I'm sure you all know, but just to reiterate one more time, once again, the mortgage payment, again, correct me if I'm wrong, is let's say 90% of it is interest, right? So you're paying the bank 90% of your mortgage a month is interest. It's not going toward the principal. 10% on the average is going toward your principal. Is that correct? I'm just using rough numbers.
Yeah, if the rate is high, in today's climate, rates can be high, especially for second homes or investors that want to buy rental property. So in situations like that, yeah, you will see the bigger portion of the payment go towards the interest rather than the principal.
But even in a prime residence, let's say, even it's still most of your monthly payment is going toward the interest and a little bit is going toward your principal. So my question is, why would somebody do a 10-year, a 12-year, a 15-year when they know a little bit of that? They're paying so much more a month. I guess if you got the money, it's okay. Who really cares? Because the majority of that is going toward the interest and you're paying a little bit, but yet you see you're taking so much money. What's the advantage besides paying your mortgage sooner?
The advantage, besides paying the mortgage sooner, is you typically get a lower interest rate with those lower terms. So over the life of the loan, you're actually paying less in interest. Theoretically, you could say that if you do a 30-year mortgage and you make extra payments, you pay it off sooner, and that way you kind of get away from having to pay all of that interest. But typically with a 15-year term, you will see lower interest rates.
So the 15 is less than the 30 as far as interest rate,
Yes.
give or take. Okay. Okay. So the 50-year option that's being introduced. The number one fear I'm hearing, and the number one concern, is that we're never going to pay this off. We're going to be renting as opposed to owning. And my first response, I mean, I'm probably older than you are. My first answer to that is my generation and my parents' generation. I remember when they got their mortgage was probably in the late 70s, early 80s. They never were able to pay it off. It was just so much that they were making enough to pay it off. 20 or 10 years later, they just sold and bought again. And that's also my generation. So what are the pros and the cons for a 50-year mortgage as opposed to the 30-year mortgage that we also accustomed to?
I mean, that's a great way to put it. There are pros and cons. Initially when you first hear this, it sounds scary at first. 50-year mortgage, you're going to be.
I'm stuck. I'm never going to get out of here. Yeah.
Exactly.
Yeah.
So, when this discussion first came out, my first instinct was, similar to yours and to a lot of people's. But having the benefit of being a lender and having a mortgage calculator at my disposal, I wanted to get down to the nitty-gritty and see what that actually translates to in numbers. So there are pros and cons. We'll start with the pros. You get a lower monthly payment. It improves your debt to income ratio, meaning you're able to qualify a little bit easier. Let's say there's somebody who's, very marginal when it comes to qualifying. They're not quite there. So this might help them get their foot in the door. So it increases your purchasing power. So, if somebody's looking at the $300,000 price range, you could increase their purchasing power to maybe $450,000.
Wow.
These are rough numbers,
Right.
but also it can be for investors. When discussion comes out of a program like this, my assumption is that it's typically geared towards, primary homeowners, first-time home buyers, things like that. But if, investors are allowed to partake in this 50-year madness, it might have some, it might be cash flow friendly for investors. And one of the things too to keep in mind is you have the opportunity to refinance later. One thing that a statistic that I heard a while back, and if I get it wrong here and there, forgive me, but most people don't stay in their same mortgage more than 7 years.
7 years.
Anyway, on average.
Correct.
So they either end up refinancing, selling something. So, it's not your forever solution. It might be good just to get your foot in the door, and then you can refinance to a 15-year later.
Or a 30-year later.
Or yeah.
Back to that again.
Now, when it comes to the negative aspects of it, there definitely are a few. I mean, if you don't see yourself refinancing, which I don't think is wise, you're you're making a mortgage payment for the rest of your life. It might even surpass you. Your mortgage might live longer than us.
But again, that's if you're planning to be in your dream home. If that's my dream home, that scenario would be correct, right?
Yes.
But I don't know how many people in their 40s or their 30s or even their 50s buy a home, and but if that's the case, then I think that's correct.
Yes. Yes. Another con, you'll be building equity slower because, like you mentioned earlier, you're not making a big dent on that principal and paying down the principal. So the equity you're building might be a little bit slower. It might even be 10 to 15 years difference between somebody with a 30-year mortgage as far as building equity.
But is it really that big of a difference from a 30-year mortgage to 50 as far as building equity? And again, if I am gonna be here for 10 years, which is a long time, and the average is 7, I'll be there for 10.
Mhm.
Is the equity between a 30-year to a 50-year in that realm that much of a difference?
Yeah, and this is all, based on speculation and
Right.
assumptions. A little bit like we mentioned earlier, on a 30-year mortgage versus a 15-year, 15 years going to have lower interest rates. It's always been that way.
Okay.
So it might be safe to assume that a 50-year mortgage might have higher interest than a 30-year mortgage.
That was my next one. Okay.
I mean, in the examples that I use just to kind of crunch the numbers and see what those savings actually look like,
Okay.
I just use the same rate.
Fair enough.
Same rate as a 30-year because, it's all speculation and
Right.
discussion at this point.
Right.
But, obviously another con that I can think of is we're obviously staying in debt a lot longer. And, it may not be ideal for some. And, but one of the things too, I think you have to approach it like an investor just to get your foot in the door because investors, and I'm not talking about giant corporation investors, I'm talking about mom and pop investors that own a couple of rental properties next door. You know, savvy investors know how to leverage mortgage products.
Right.
So right now, we have 40-year mortgages. Those exist right now. They're not, the typical Fannie Mae, Freddie Mac mortgages. They're usually some lenders offer them and they kind of keep them in their portfolio. So they're not sold off in the secondary market for the most part. But 40-year mortgages do exist these days, and a lot of them are interest only for the first 5 years, 10 years. You have things like hard money loans, which you're familiar with. It's short-term interest only, geared towards investors. So they know how to utilize and leverage these products because they know that they're either going to flip the property and sell it, and they're trying to maximize their cash flow in the meantime, or they can refinance it to a fully amortizing loan, a 30-year fix, or what have you. And I think after the initial shock, you have to think of an approach the same way that an investor would approach it.
So let's do some numbers just to bring it down to earth.
Yeah.
I mean, that's the only way I think any, let's not talk about investors. We're all here trying to stay alive. So a sample of, you want to do the 30-year and the 50-year?
Let's do that. Yeah.
Okay. So you want to do a 350, which is an entry level condo, first time buyer, 10%.
Let's do that.
Okay.
So with a $350,000 sales price, which is entry level for a lot of people, like you said, 10% down with an interest rate based on today's national average, 6 in the low sixes. Your mortgage payment is going to be roughly a little over $2,072. That's for a 30-year fixed.
Correct. So
Or
everybody's listening, for the 30-year mortgage, it's for a $350,000 purchase with 10% down. Obviously, if you put 20% down, it's better. If you put 30% down, it's even better. If you put 50% down, if you get the money, better. But we're talking about affordability here. So that's $2,072.
yes, and that's with principal, interest, and mortgage insurance, PMI.
Okay, perfect.
So if we compare that to a 50-year mortgage,
Mhm.
when I see 600 months, it's scary.
Huh?
But the total payment is going to be $1,850.
So savings of,
Savings of $222.
and that's, should we do one more, another number?
Sure. I
Let's
mean,
say,
initially when I wanted to crunch the numbers, I just kind of used, an average value here in the Coachella Valley, for example. So, it's $700,000 more or less, depending on what city, what part of the Coachella Valley you're in. But if we put 20% down for a 30-year with that same interest rate, your principal and interest is going to be $3,451, so a little over $3,400, compared to a 50-year at that same rate. Your mortgage payment is going to be $3,056. So that's about $395, almost $400 difference
savings.
in savings. Yes.
So it sounds like if the purchase price is more than entry level, and your down payment is more for the ones that can afford to put more down payment, you're still savings.
Yes.
It's more savings than the it's actually double. It's $400 savings as opposed to if you're putting 10% down, and you're doing an entry level mortgage, $250,000, you're saving $222. So it's interesting that the higher you go, the higher the savings.
Yes.
It's just dawned on me. So the more you purchase, and the more you put down, the more you'll save. The more you're paying less.
Absolutely.
Okay. Have your phone been ringing differently since this kind of idea was introduced, which is like a week or so ago? It's not that long ago.
Not as much as you would think.
Right.
Just my standard typical clients call me for either a refinance or a purchase.
Right.
But a lot of the reactions that I've seen were online,
Right.
the court of public opinion.
Right. It's astonishing. And I invited everybody to listen to this. I didn't even know what we were going to say. It's not like we had this pre-rehearsed, but I said, at least listen to it and see what you make out of it for yourself. But I instantly got the reaction, from, to become a renter, to rent more, to rent for life, and to all these things. And I'm going to say this, and I think the reaction probably is based on not the message itself, but on the messenger. Yeah, I don't think that's how a human operates. That's how we all operate, including myself. When you hear something, it's not so much about the something, it's about who said it and how they said it.
I can see that.
Yeah, I think that's just, and then we react to that based on that without just stepping back.
Yeah.
And actually, I was surprised. Kevin O'Reilly, from Shark Tank, was the first one to come out and say, "Oh, I don't like it because you're going to be a tenant forever." And Kevin of the world, they pay cash.
Yeah.
Kevin of the world, they can pay a 10-year mortgage or 12-year mortgage.
Yeah.
So I don't know if he's concerned for the rest of us or he's just, I'm not sure. But anyway, again, we're not here to tell you what to do.
Yeah.
We're not here to tell you what's best for you, but I want to see what the numbers say. I honestly I had no clue that those would be the numbers. So again, on in case you did not write this down, on a 30-year mortgage for a $350,000 mortgage, right? Not purchase, mortgage.
Purchase price.
Oh, purchase price. Okay. So
Purchase price.
$350,000 purchase price, 10% down. The 30-year is $2,072. And the 50-year is $1,850. That's a savings of $222. On the higher price, on a $700,000 mortgage, the 30-year is $3,451, and the 50-year is $3,056. That's a savings of 400. I think it was 400 and change, $400.
Mm-hmm.
Okay.
Something to think about for sure.
Something to think about. Yeah. I personally, if I was in the market, to me, I always go back, and I've said this 1,000 million times. I don't care what the interest rate is. I care what the payment is.
Mm-hmm.
You know, most people get so stuck on 6.0, 6.7, 5.1, 5.9. You know, what you can afford versus what I can afford is very different. So maybe it's about what the monthly thing is for me,
Mm-hmm.
and that's what I focus on. So I don't know if I'm going to be in my home for 50 more years. So, you know, if I can save $400 a month and the mortgage or $222 a month, I think it's an easy decision to make for me.
Mm-hmm.
So, do you have any? Let's change topics a little bit. Do you have any? I know this is off the cuff here. What are your numbers on people applying for mortgages now versus like a year ago? Roughly, if you have that.
You know what? It's about the same. Right before the holidays, for some reason, there's a lot of activity. So right now, I've got a handful of people pre-approved, you know, coming from out of town or here locally, and it tends to kind of. I hear that it slows down during the holidays, but I do see activity, and rates are in a better position than they were a year ago. So there is more activity and people applying and wanting to get pre-approved. One of the things, yeah, I mean, the media gave the mortgage world good press these days. So, you know, as soon as people hear something
They react.
online, on the news,
They
they
react.
react. Even if those rates had already been low for the last 2 months, you know, because lenders usually kind of hedge that
Right.
in advance based on expectation.
Right.
So to answer your question, I would say about the same, if not a little bit more
As
uh,
from last year.
last year.
So
Mhm.
how do you explain the stagnation?
The what? I'm sorry.
Stagnation in the
Holidays,
market, huh?
holidays, maybe holiday
I'm
season.
in a different end of it than you are.
Uh-huh.
So I don't know, maybe you're getting like 10 pre-approved or 10 qualified on your desk. But from our end here, and I'm sure you've seen the stats on,
Mm.
let's say, the condo market. And that's actually not just in Riverside County or the Coachella Valley, that's actually in LA as well.
Mm.
It's in the red, except for 2 cities in the entire valley.
Oh, really?
From a year ago. I
Mm.
think the last report that we got from the board in October. No, we got November already. November to last November.
Mm.
And I don't to be negative, and I hate fluffing things up. I
Yeah.
just rather say it as it is instead of saying everything is hunky dory. Short sales, which I was shocked, are up.
Mm.
There was short sales were a thing back in 2009, 2010.
Yeah.
I did my first one back then. Now they're moving easier. Lenders are much more aware and they're closing them faster, not in 6-8 months. But there's like I know of 2 closing that happened, and I know there's about 5 homes that I know of that are short
Mhm.
sale, which you probably don't get that because you're on different, you don't hear of that because you're not on the buying side, you're in the lending side. So you
Yeah.
might not get too much of that. Um, I'm just wondering if they're the pre-approval, like where they're going, if they are, is just, I think it's very smart to get pre-approved, obviously. So yay to them or their agent that's compelling them to do that step. It's the first step to
Mhm.
do. I'm just wondering why is that not aligned with the numbers as far as sales wise? I mean, there are sales being made, don't get me wrong. But
Mm.
it's certainly not as, um, especially the condo market,
Yeah.
especially the condo market.
Condo market has definitely, faced some challenges. A lot of it being with, insurance, um, and but we've seen that improve a little bit. So the master insurance and the condo association may have, I don't know, certain restrictions. Not to go too deep into it, but so there's been some challenges with that, and it's funny because in a short amount of time, um, a lot of these condo projects became what they call as non-warrantable.
Meaning,
Meaning that there are different things that would make a condos project, non-warrantable. And it could be because there's not enough coverage in the master insurance. Maybe there's pending litigation.
right?
Um, Maybe there's a higher concentration of investors rather than, like occupant buyers. So when you have a non-warrantable condo, they make it a little bit tougher to lend on
Right,
with a conventional loan.
right.
So I'm guessing that plays a small part in seeing those stats with the condos. Um, but I mean, it is, it's not absurdly busy with, everybody trying to get pre-approved. You still have that, I mean, there's a ton of activity, but you still have the issue of affordability and, definitely plays a big part in it. Uh, the kind of referring back to the discussion we had earlier with the 50-year mortgage, is that going to fix, ultimately the issue that the underlying issue of affordability and supply? No, it's not. In fact, it may even drive up prices even more because now you have all this competition and these buyers entering the pool because now they can afford it or they qualify for it, I should say. Um, so, does it fix that underlying issue? No, but it's definitely a discussion to have.
You couldn't have said the word better, and I've said this over and over again, and it's my last point, but already plugged it in, the word affordability. And I had a broker from Portland 2 episodes ago spoke about the same thing. Um, the fixation that we have as agent and as people in the industry about the interest rate as if it's going to be our saving grace, it's going to be the lifesaver that's going to take us to the Garden of Eden, is just an insanity. And I think I thank you so much for bringing the word affordability, because I've been around when interest rates were like 12% and 16%, and it's been 5%, and it was 2%, and now it's 6%. And like I said earlier, I look at it, what's the mortgage payment? Can I afford this? And now where everything else is in play,
Mhm.
even the 1850 for entry level, plus um, let's say if it was a condo, there's HOA and um, I think that's it because you did the insurance. That might maybe end up, probably at around 21, 22. That somebody that is an issue, and plus a down payment, some people say, let me rent for now, because renting, I can rent the same and keep my money for
Mhm.
now. So the affordability thing is, I think, is a major, major, major key word
Mhm.
in considering all of this. So do you think interest rate? I mean, you said it yourself earlier. I just want to have you reiterate it if you want. Is interest rate, that we're playing with and hoping for, is it playing a major factor in the current situation that we're having, as far as stagnation, as far as um, how many people are moving forward?
Yes, a lot of it has to do with consumer sentiment. So even though mortgage rates are moving lower than they did maybe a year ago, um, you're still going to see, some people be more hesitant because they still think it's too high. Um, at the end of the day, it just, people will buy houses, sell houses, depending on need. So, if you can't afford it at the moment, if it doesn't work for you, then, it's something to revisit, in the near future. But if you need to, uh, it's always, I mean, I think we've all had uh, an experience where we try to guess and predict what the market's going to do and be completely surprised by it. So, you don't want to lose out on building the opportunity to build a ton of equity. But, if you have to rent for now, that's okay too.
I think the biggest kiss of death is that hoping and wishing. I think if it's been like over a year now, oh, the feds will do this. The Fed will do this. 2 more
Mhm.
months. Give me by this quarter, by that quarter. Next thing you know, we're in December. The
Yeah.
year went by, and I think it's just because humans always want to like be so hopeful, and again holding on to that one piece of of the equation that's gonna, once that gets done. And I heard so many agents, which you probably have as well, you know get ready, buckle up, the feds
Yeah.
are meeting tomorrow. I'm like, really?
Yeah.
And then the feds meet tomorrow, and next thing you know, you guys, I mean, you in the industry, it goes up by half a point, the interest rate for the mortgage, because it's
Exactly.
not related to what the feds do. I don't know if
Yeah.
you're going to explain that or not. I already went through this when explained this 2 episodes ago. If you want to explain that again, you can. How what the feds do doesn't mean you will.
hmm Well, yeah, yeah, thank you for bringing that up. One of the most common misconceptions is that the Fed controls the interest rates, the
Right.
mortgage rates,
Right.
when that couldn't be further from the truth. Now, it may follow similar trends, um, but it depends on other economic factors. The mortgage rates are controlled by the bond market, for example. And a good indicator to watch out for is the 10-year Treasury yield. 30-year mortgage rates seem to follow the same trend as the 10-year Treasury yield. But essentially, it is, set by the bond market. And so when you hear the news, um, we try to do the Lord's work and spread educate people on that. But as soon as the Fed lowers the, federal funds rate or whatever by a 1/4%, everybody thinks, well, did my existing clients that I have now that I locked them in at an excellent rate, they always ask, well, did my rate go down? I said, no, it actually,
It's actually went up.
mortgage rates went up. Exactly.
Yeah.
Uh, so a lot of the times what people don't understand is that before you hear it in the news, about a month before you hear it on the media and online and everything, lenders have already hedged that. They've already built in that pricing and those rates based on expectation. So sometimes our expectation are a little high, but then, the Fed or whoever, whichever economic factors end up taking place may have the adverse effect on mortgage rates, so they may increase. Um, but as far as the mortgage rate trends, where they'll be moving, where they are currently, I think we're in a decent space right now. If I look at my crystal ball here, I have
Yeah.
a
Hold on, let me
crystal
get
ball
my,
here that
oh,
tells
you
me.
do? I don't have one. I need to get one.
I think they will continue to trend down. It may be slow, but they will continue to move on the lower side. So
But again, let's finish the sentence. The trend is it'll go down, but as you said not even 60 seconds ago, that does not equal to,
affordability.
no, the mortgage rate. I mean, you're talking about the trends for the feds or the trends for the interest rate for the
For
mortgage,
both.
for both.
I'm mainly talking about the trend for mortgage rates. I do see them going down based on everything I hear and I read. But then again, one of the things that I've thought about is at this point, all the experts have been wrong at predicting. So, it's all speculation. Some event, could happen that could cause mortgage rates to fall dramatically. But then again, all the experts and the people who predict these things, in the finance world have been wrong. At this point, we might as well get somebody who actually specializes in predicting the future, like a fortune teller, psychic. It might be just as good of a prediction. But all jokes aside, I do see mortgage rates moving down, and that will improve affordability a little bit, but it won't fix affordability and the supply issue 100%.
I think the supply issue is very well solved, especially here. I don't see a supply issue as an issue at all for our region here. I don't know about other places. I think the supply is fine, a lot better than it was 2 years ago.
Oh yeah, I agree.
But if you're telling me, if I was coming to you for a mortgage, and you're telling me the experts are saying, I'll say, well, Camille, I might as well just wait for another year because if it's gonna come down this, I'll just wait.
Mhm.
Well, what do you say to me? What do you tell me? Because the expert says,
Yeah. Well, like we mentioned earlier, we've seen, what the experts say and then what actually happens.
right,
Um, so you waiting, let's say you're right at the edge, qualifying wise, you're pretty marginal. If you wait, you run the risk of getting yourself out of that qualifying range. So now you won't be able to qualify. If rates do go down, I always say, it's a popular saying. I didn't make this up, but it's date the rate, marry the house, kill the rent. But your mortgage rate that you get now is not your forever solution. And if we were all listening to others based on prediction, I mean, we'd I don't know, place some bets somewhere. Um, but you can always refinance. That's the beauty
right.
of
I would add, this is how I would say it from my end of it, which is way before they come to you. I would say, unless you are in a cash situation and 100% your finances are secure, which meaning you don't have to worry about employment. You don't have to worry about things that financially would change, then yeah, you can wait and still be okay. But if you're employed, and let's say, God forbid, you lose your job for whatever reason, they downsize, they move you, whatever the case might be, then there goes that qualification. If you're an independent contractor and your income varies, you had a good year 1 year, you had a bad year the second year. So that year that you waited for and your income changed because you're an independent contractor, like a lot of us, then your qualification changed. What Camille qualified me for now is completely different.
Exactly.
That's another thing that you have to consider. So again, anything can change in somebody's life. If you had a medical crisis, God forbid, and that took your 20% savings to 10%, there goes your qualification. So there's such a lot of risk unless you got plenty of money in the bank and your medical crisis happened and you can pay that off and be okay. And you're not working, but you get investments rolling for you, you're okay. Then I suppose wait, it might be a good idea. That's my
Yeah.
couple of pennies.
I agree 100%. And at the end of the day, if it's right for you at that moment, then it's right for you. If it's not, then, maybe something you need to revisit.
Right, right, right. Thank you so much for clarifying the confusion of our confusions. And I'm glad you came and broke us all down for you. Thanks for the numbers, by the way. That was very helpful. And for the ones that are listening, I hope this is helpful to set your fear aside. And at the end of the day, like we said, do what's best for you. If you're if a 30-year mortgage is fine, if a 15 mortgage is fine, if a 50-year mortgage is fine, do what works for you. Do what works for you. But I think operating out of fear is a huge mistake. And reach out to Camille if you have any questions about the mortgage, or if you need a mortgage broker here in Coachella Valley at Contempo Lending, which is on Techwitz, I believe, right? You guys are, yeah. And if you like the episode, please come back and subscribe. And it helps me bring people like Camille back. And have a great Thanksgiving, everybody. And I'll see you in 2 weeks. Thank you.
Thank you for having me, Sam.
Welcome.